Hello everyone and welcome to another video of this course. In this lesson, we'll be looking at accounting methods in oil and gas. And under that, we're going to look at the successful efforts method. We are going to look at the full cost method. We're going to look at advantages of the full cost method. We're going to look at key differences and financial statement impacts. So let's begin. Accounting methods in oil and gas. Oil and gas are industries that are well versed in, which means that we understand the level of nuance and depth that goes into accounting for this sector. Every business within this industry has their own style and unique needs when it comes to accounting. But it is always better to have an overview of industry standards to start with, especially since it will have a direct impact on how financial statements are viewed and analyzed. The first component to understand when it comes to accounting for oil and gas is that there are two standard methods, which are the successful efforts method, SEM, and the full cost method. So let us look at the successful efforts method. The successful efforts method allows for companies to singularly capitalize on expenses which occur due to successful location of new and natural gas reserves. For any unsuccessful result that might occur, the associated costs of the operations are charged immediately against revenue made during that period. According to the theory behind the SE method, the ultimate objective of an oil and gas company is to produce the oil or natural gas from reserves it locates and develops, so the company should only capitalize on those costs relating to successful efforts. Conversely, because there is no change in the productive assets with unsuccessful results, companies should expense costs incurred from those efforts. Now, the full cost method. The full cost method is an accounting system used specifically by extractive industries such as the oil and gas companies. In this technique, all exploration operating costs are capitalized, regardless of whether they were successful or not, and then amortized into expenses over time as the total reserves are produced. This method grants companies the ability to capitalize on all operating expenses occurring during a certain period, regardless of the outcome when it comes to locating new oil and gas reserves. This approach stands in contrast to the successful efforts method, which only capitalizes expenses related to fruitful extractions ventures. Now, let us look at the advantages and disadvantages of the full cost method. Choosing the full cost method comes with a series of benefits and drawbacks. Until an impairment occurs, reported profit levels can appear to be deceivingly elevated, since the expense recognition for so many costs have been deferred to a future date. Higher net income may make the company immediately seem more attractive to investors than competitors and help it to raise new capital. At the same time, capitalizing on successful exploration costs rather than expensing them results in the company being more susceptible to large non-cash charges whenever the preceding factors result in an expected cash flow. Now, what are the differences between the successful efforts method and the full cost method? The key difference lies in the success of finding oil and gas and how that is translated across balance sheet. Some choose to view this as the discovery being the true need, which means that all operational costs incurred during the discovery process should be counted, which is where the full cost method comes in. Successful efforts are more focused on the end product and believe only those expenses incurred to find and produce oil and gas should be capitalized. Now, there is no right or wrong way of deriving true value of the business, and the cost associated with either method will likely fall into similar categories. It is more of how the business is viewed and personal philosophies that fuse into the accounting strategies for businesses in this sector. According to the view behind the successful effort methods, the ultimate objective of an oil and gas company is to produce the oil or natural gas from reserves it locates and develops, so that only those costs relating to successful efforts should be capitalized. Conversely, because there is no change in productive assets with unsuccessful results, costs incurred with those efforts should be expensed. Proponents of the full cost method, meanwhile, contend that the dominant activity of an oil and gas company is simply the exploration and development of oil and gas reserves, meaning that all costs incurred in pursuit of that activity should be first capitalized and then written off over the course of a full operating cycle. So what are the key differences between the successful efforts method and the full cost method? And we're going to be looking at them in terms of capitalization of costs, depletion, depreciation and amortization, balance sheet, income statements, and impact of cash flow. So, under the successful efforts method, only costs directly related to successful exploration, development, and production projects are capitalized. While in the full cost method, all costs associated with exploration, development, and production are capitalized, including those from unsuccessful ventures. With regard to depletion, depreciation, and amortization, under successful methods, depletion, depreciation, and amortization is based on the cost of successful assets. It's lower initially under successful effort, but can lead to higher charges later as reserves are depleted. Under the full cost methods, DD&A is based on all capitalized costs, leading to higher initial charges. Later, as reserves are depleted, the DDA may appear less significant. In terms of the balance sheet, under successful efforts, asset valuation is typically lower initially, but can be more realistic as only successful costs are capitalized. While in the full cost method, asset valuation is higher initially, potentially reflecting less realistic view of the economic value of reserves. With regard to income statements, the depletion, depreciation, and amortization expense will be lower in the early stages due to lower capitalized costs. Later, as reserves are depleted, the DD&A expense may increase more sharply. Under full cost method, the DD&A expense will be higher in the early stages due to higher capitalized costs. Later, as reserves are depleted, the DD&A expense may appear less significant. And then its impact on cash flow. In successful efforts method, this may lead to a more accurate reflection of cash flow as only successful projects are capitalized and expensed. But on the full cost method, it can potentially smooth out cash flow as costs are capitalized. And lastly, we have the aspect of oil and gas industry or oil and gas accounting, and they include reserve accounting, revenue recognition, exploration and development costs. We also have depreciation, depletion and amortization. We have joint venture accounting, we have hedging activities, and we have reporting compliance. So under reserve accounting, we have that reserves are estimated quantities of oil and gas that can be economically recovered from known reservoirs under existing economic conditions and operating methods. Under revenue recognition, we have that revenue recognition in oil and gas accounting can be complex due to factors such as production sharing agreements, joint ventures, and royalty payments. Now, in terms of exploration and development costs, whether you're drilling, conducting or carrying out other exploration activities, companies need to account for the cost of exploring and developing gas reserves. Now, with regards to depreciation, depletion, and amortization, also known as DD&A, as oil and gas reserves are extracted, companies need to allocate the cost of acquiring and developing these reserves over time. And depreciation, depletion, and amortization accounting method is used to spread this cost over the life of the reserves. Now, let's talk about joint venture accounting. Many oil and gas projects involve joint ventures where multiple companies collaborate. Joint venture accounting is crucial to accurately reflect each participant's share of cost, revenue, and other financial aspects. Given the volatility of oil and gas prices, companies in this industry often engage in hedging activities to manage their exposure to price fluctuations. Accounting for hedging transactions is an integral part of oil and gas accounting. And then lastly, we have reporting compliance. Oil and gas companies need to adhere to specific regulatory and tax reporting requirements, and their financial reporting has to comply with industry standards and guidelines. These requirements vary widely from state to state, and it's important to have a system that can support these requirements and make compliance a breeze. We will stop here for now. Thank you for watching this video. In the next module, we will be learning about cost basis in oil and gas accounting. Thank you once again, and bye for now.